Hey everybody, this is Aaron Trevino. Welcome back to our real estate and construction YouTube channel down here in the state of Texas. We have Brad Cahoon from the Dallas area. A really interesting background. He's doing a lot of neat deals, background in lending and insurance, and does a whole lot of real estate. Brad, how you doing?
Doing great, Aaron, man. How you living?
Hey, I'm great. I'm great. I know we initially connected. I was intrigued by your background and a little bit of your story. I know you told me before. Oddly enough, you got into real estate on the lending side. Could you tell us about your introduction to real estate, and did you always see yourself going in this direction?
No, man. So my background, like college, I actually got a degree in computer information systems, but I graduated the semester 9/11. So I ended up in mortgages at Citibank there as a processor, and then I became a loan officer after a year, and then went to Countrywide for 2 years. Then I became a team lead at a small company called Dallas Home Loans, which doesn't exist, and then a branch manager at a place called AAA Worldwide that doesn't exist. Then we started Global Home Finance in 2008 of all times, and we were kind of forged in the fire. And then I did, a lot of deals. Was working in mortgages from '03 probably till I guess I started looking at buying besides a primary residence about 2010, and started getting into buying land and like house some other houses like a duplex and a couple other things, and then eventually worked my way up to commercial buildings. I shared with you a guy named Jerry who is an attorney for New York Life. Did a 1031 exchange, moved from New York up down to Dallas, bought a really nice house in Turtle Creek, one of the nice areas in Dallas. And then he got a duplex in Dallas across from the Dallas World Aquarium, commercial building in Louisville, a few single family residences in Denton where there's multiple colleges. And he replaced his income of about 20,000 a month with New York Life with real estate income to become a jazz singer of all things. So, that was like, oh man, there's my aha moment. I'm gonna do that. That's awesome. I want to be that guy.
I guess from that moment on, you were sold.
Yeah. And so fast forward, I've got commercial buildings in Louisville and Oklahoma, and then I've got land in New Mexico, Texas, North Carolina, and Florida, and houses in a couple of states. So yeah, we're living the real estate dream. Andrew Carnegie said that 90% of the people he knew got rich through real estate, and he's one of the first billionaires ever. So follow the crumbs from the people that have been successful at it, and you might get your own bread, I guess. Aaron, right?
Sure thing. Yeah,
Yeah.
I'm always curious about, how people get started as well. What was it like? I know you told us that story about Jerry, but what was it like? Did you see that lending opened your eyes in particular, or how was it unique getting
Yeah.
started in lending of all spaces?
Well, so it gave me the confidence, I think, to be able to like, I can do that. Because I'm helping this guy get the money. Getting the money is the hardest thing, getting your deals done, right? Getting the loan, and then if you have to get an equity investor for your capital stack to get a deal done, you have to go and hustle and find that. It's like, well, I already know that people have money because I look at their financials. They come to me and they're getting loans, and then I have you know a background in lending, so I can get my own loans. I know what's going to pass and where to take it. So it's like, dude, I'm going to just kind of reverse engineer this, and I know I'll back into these. I know what the numbers are going to be, and if they're going to work, I'm evaluating if you're going to get a loan. So why don't I just start doing that for myself? And then we added insurance in 2017. We bought a agency and got all their carriers really, and I had a girl so that we could start writing policies and just off to the races. We 5x that business in 7 years.
Wow, how about that?
Yeah.
It seems like there's been a tremendous amount of growth. I was really intrigued that you started in 2008. What was what was that like?
Yeah, I told you we were kind of forged in the fire. I was, young and dumb. I was about 28 then, and really the idea formed December 31st of '06. I decided I'm getting these other people rich. I'm getting this guy who's a Scientologist, where he's driving around in a Ferrari, and I'm running a team for him of people, and I'm like, I'm going to do it for myself. I've done this for enough that I'm just going to try it out on my own. And so I went and got a multi-function center printer, Brother MFC 8460. I remember what it is, and it's got like scanner, fax copier, and all that. And so I went to Fry's Electronics over in Irving, Texas, up MacArthur and 635. Bought that, went home, hooked it all up, and then by February I quit there completely and did a branch of someone else for a little while until I got my broker's license in Texas in March of '08. And so, everything starts falling down around you. You're watching all those places go out of business, New Century, Option One, the big subprime lenders. And, we just muscle through. And actually, when HARP came out, we started making good money when a lot of the places were still failing. And then we started hiring people from these failed places. I've got a guy that has been with me over 12 years. It's not related to me. And, there were people that worked with me for 9 years from that time on because we were making money when other people were just desperate. They couldn't figure it out because we were doing the home affordable refinance programs would let you go up to like 125 loan to value. You get a 65 debt ratio on Freddie, and Fannie didn't really have a max. They did something to see if it made more sense, basically, to not take your house. It's called a waterfall calculator thing. We found out because we hired a guy to help make that calculator. Okay, for Fannie Mae is what Raylan. And so we basically started writing all these mortgages that other people just didn't try to figure out how to do or didn't want to help others. They wanted to stick in their lane instead of get outside their comfort zone. And so we made a business out of it. And here we are, what is it, 17 years later? So
I guess it worked out, huh?
yeah, somehow me and my brother have figured out how not to kill each other and make some money on the side.
All right, fair enough. I'm curious how did no one think of this, right? You were saying these other guys are just trying to figure it out. I know you talked about hiring a real smart guy that made the calculator, but why couldn't anyone figure this out?
It's not that they couldn't figure out, it's that some of the banks just don't care to help. Either that or they don't effectively train people. So like the big banks, the people who work there are not licensed. Okay, when you earn mortgages, okay, they're exempt from licensing and they fail the test that a loan officer who works under my license has to take at a rate of about 58% of the time the first time they take it. Okay, so they're supposed to receive like training at the bank, but the results on their testing afterwards don't show that. And we don't like to hire people from banks, by the way, because they have bad habits and they're used to just doing these type loans at these guidelines. And banks are what called overlays on top of the government sponsored entities rules that makes it prohibitive because they don't want to take risk. All right. And so they don't want to service loans and make default and take losses, even if it's nominal, because they're not interested in that type of business. So they say, okay, we're not doing anything over 50% debt ratio, like on an FHA loan. Chase and Wells Fargo do that. So does Rocket. Right. And so they say, okay, we're not going to do that loan, even though really you could go to a 57% debt to income ratio if they've got a couple of compensating factors. You have 47% housing, 57% total debt ratio for that instance. They choose not to help everyone they could. That's the easiest way to say it.
That's a really interesting distinction between, choosing not to versus being able to.
Yeah, they absolutely could. It's a
Yeah.
choice. It's a conscious choice by the executives in the organization in order to mitigate risk.
Absolutely. Makes a lot of sense. So again, I thought it was so interesting. You started in 2008. Obviously a lot has happened since then, and there's been a shakeup in the economy. I'm just curious, what are the best loans for investors going into this new year in 2025?
Oh, hard money and DSCR loans are hot. Both of them are really just picking up nicely. I've had a number of loans we've seen come through just the last couple of days on there. It's really picked up. We're getting through the holidays. They're shaking off the dust and getting back out there looking for deals, and people are starting to sell properties again. So DSCR and hard money are for sure hottest right now. Some ground up construction too, where we are, in Texas. We had a city not far from here, Princeton, announced yesterday that they weren't going to allow any new building in the city. They went from being probably a town of like 2,000 people 15 years ago to having 1,000 houses a quarter being built.
Wow.
They said, we're going to slow it down. We got to put some infrastructure and safety. And there's what the mayor said, why they paused the building. Never
Oh
seen
my
that.
goodness.
Yeah, surprising. I've never seen that in my 22 years of doing this. Never seen
Wow.
that around here.
Huh.
Yeah.
That's a crazy amount of buildings being built, but also I guess, you need the infrastructure for it too.
Yeah, the builders are just like, hey, how many lots can we buy? And it's a little cheaper because we're a little further east of the DFW Metroplex. So we like a couple of months ago, I think it was November, December, I showed a guy that Lennar had houses for 190,000. Yeah. New build for 190,000 DFW. Nobody almost knew they existed, because they didn't mainly. And they were small houses. They're like 900,000 square feet and they're wood frame, but still new build. You're on a budget, you can probably afford that.
Wow.
Yeah, when everything else is 300 and up around here for not very nice house. It's old.
Yeah.
It's like 190 for new build. Sign me up. You know,
Yeah. So true. So
I showed a
true.
guy that was buying 4 houses, an investor, that they had him because like I can't find anything under 290 over on this side of the DFW. I'm like, look over here, and prove that they had them. So
Wow.
yeah,
How about that? And out of curiosity, why hard money right now, right? Is that more would hard money be for someone who really can't qualify for a normal bank loan, or why do you think that hard money is really blossoming right now at this time of year?
I think some of it is they can't absolutely, but also it's just easier. Commercial, you go get an SBA loan. What's the rate? 10, 11%, and it's adjustable. So what's the, and then it's going to take me 120 days, 90, 120 days to get it done. And I have to give you everything but my left kidney. Nah, I'll just pay an extra percent or two and get it done in a couple of weeks and have less paperwork and brain damage. I think that's why.
That makes a lot of sense, especially, I know years ago, people were making money hand over fist, right? And the market was moving so fast, they wanted to pay for that convenience, right?
Absolutely. And that's a piece of it. If you've got a motivated seller who has to close because they have some sort of issue, like maybe a foreclosure coming up, then you have to perform fast. So you can't wait around for a bank to figure out how to add two and two, you know. So yeah, you've got to move fast, execute, and then who cares if you paid 2% more on the rate?
Hmm.
If you made 20, 30% equity pickup on, gain on sell when you liquidate it, man, that was a great loan.
Sure thing. I know you mentioned a little bit of ground up construction, but do you find, I know obviously in Texas we're in a housing shortage. Do you find that most of those hard money loans are for ground up construction, or are you actively seeing flips too?
Oh, flips too. Flips for
Mhm.
sure. I think the margins are compressed on profit because the competition's too high for flips right now versus what it was a couple of years ago. But if you find the right deal, it's absolutely can be a gold mine. You get a relative that's inherited, mom or grandma's house, and they don't want to deal with it. They just want to get rid of it. They'll give you a fair deal, and you can make some money on it on there, and you see those deals pop through. There's people who market probates. I know it's kind of morbid, but they send mail pieces to people in order to try to help them liquidate the estate. And I mean, they're providing them a service, and they are getting good deals that way because they're not focusing on maybe like trying to find something through the MLS or realtor, maybe even a wholesaler who only hands out the deals that they don't want. You know.
Mhm. I guess that's also the risk. Speaking of wholesaling, do you find that the margins are compressed on wholesale deals as well? Because it's one thing to flip and the
Mostly.
margins are already compressed, and then I buy it from a wholesaler, right?
They inflate the value. They tell you the ARV is going to be way higher than it is. You need to run your own comps. You need to have a realtor that knows how to do investment properties, or you need to have access to the MLS yourself to run a CMA, comparative market analysis, in order to be able to be sure that the values are afterwards. Then you have to know how to estimate what the actual repairs are effectively. So if you're a contractor who's estimating every day, that's not a problem. If you aren't and it's your first one or you're newer at it, then using spreadsheets and getting quotes from people is imperative on that to make sure you're not putting yourself in a losing proposition.
Sure, it makes a lot of sense. And could you also explain, what a DSCR loan is and why, along with hard money, why are DSCR loans really taking off right now?
So DSCR loans are debt servicing coverage ratio. Okay, so it's a ratio, or we look at how much profit do you have monthly on the actual property. So we look at how much your PITI is, principal, interest, tax, insurance, and any association dues on there for the house. And then we look at how much your rent is. And so if you're over a 1.0 DSCR, that means you have profit. So 100%, basically. Okay. 100% of if you're a 1.0 DSCR, you literally have PITI that's exactly the same as the monthly rent. So anything above that, like if you're at 1.25, that's 125%. So you have a 25% profit margin. Okay. So we know then that's cash flowing. That property will pay for itself. So I'm confident in writing. I don't need to look at all your tax returns and get 12 months or 24 months of bank statements and all these other documents that, more traditional type or even non-qualified mortgage loans often look at. I'm just going to look at the subject property's cash flow. Give me your rental agreement, and then maybe a couple of months of bank statement showing the property is receiving the rent you're claiming. All right. And then I'm going to do an appraisal that has the rent comp analysis on it to show me that you're not inflating the rent, try to pull a fast one on me, that that's truly a market rent. And if it's not too far over, within probably 20% what the appraiser says, here's your big pile of money. Go buy some more.
And
And
rinse
then
and
I guess I
repeat.
didn't answer the other part of your question. That answers what it is, and then why is it hot? I think it's because first off, investing is high still on there. And so you see people refinance out of hard money loans into those DSCR loans a lot. Or if they're buying a house that's rent ready, that's in good shape, that they can just turn into a rental immediately, they can finance those more easily. And the rates aren't all that much higher. I literally quoted one of those yesterday at 7.49 with 1 point.
Mm.
Okay. So the product, requires a little higher equity. You probably have to have 25-30% equity most of the time on those. We can go to as low as 20, but usually the terms aren't as good. But if you have 25-30% equity, we can get you some stellar deals if you have
Mm.
above a 650 credit score.
Solid. Could you also explain that transition from the hard money and then refining out, and then also that equity piece as well? I'm just trying to see what would a timeline be for an investor from the time that I get the hard money loan to actually refining out.
Yeah, great question, Aaron. So when you get a hard money loan, usually it's 6 to 12 months for most of them. Sometimes they'll go up to 2 years or more, but maybe even five, very few. But what happens is you've got to fix the place up often. It's a fix and flip type situation. I'm going to buy the property and then I want to fix it and I sell it. Okay. But when you want to keep it and rent it out to someone else, it's a fix and rent, then it's a two-step process usually if you've got to do the repairs unless you have cash. So you get the hard money loan, they finance the acquisition plus some amount of the rehab. And then after the rehab is completed, whether it takes 1 month, 6 months, 7 months, 8, 9 months, when that's completed, then you get it rented out. And then we can go in and do that DSCR loan because we can show that you have a rent agreement with security deposit and first month's rent on there, that the property will cash flow and be profitable versus the amount of the new mortgage, so that you can then keep the property and turn it into a cash flowing piece of a real estate or an asset for yourself that pays you residually monthly instead of just liquidating and getting a one-time paycheck. So
Okay. Great. You're kind of getting the best of both worlds in a way.
absolutely. And it's, maybe 30 days, 4 weeks, I'd say, afterwards, because you got to do an appraisal
Mm.
and then we update title. I mean, really, we can do 2, 3 if you're Johnny on the spot or Janie
Yeah.
on the spot with your documents. But, depending. So,
Sure. So from a lending perspective, do you find that you looking for multiple exits from a deal, right? Maybe if this particular option doesn't work out, do you want to see someone that's presenting the deal to you that they have multiple exits?
so we always want to have an exit strategy on a bridge or hard money loan. I mean, it's either usually sell or refinance. I mean, that's pretty much the main options, right? And so, anyways, it doesn't, I guess, probably impact it most of the time, but just to know and to have them understand that, hey, if you can't sell it, it's better for you to probably refinance it if you can than having to pay a lot of extension fees.
Mm.
And so it's really just giving them that knowledge that it's there because not everyone knows that. There's no financial education for most people in this country. Let's get real. Okay. They maybe teach you how to do a checkbook or balance a checkbook, do account T charts and like some sort of math and money class in high school nowadays. They're not like, oh, here's how you shop for mortgage, here's how you shop for insurance. And then PS, here's how you go and structure a ground up construction to see if it's going to be profitable and look at the numbers on it. Or here's how you budget a fix and flip. They don't do that. They don't even do that in college that I know of. Like maybe you can get some, fine if you're a finance major, you get some practical education or your accountant and managerial accounting, things that show you time value of money. But most people just don't get practical financial education. Unfortunately, it's not, a piece of what we learn. So giving the people that information when they're going through the process is, I think, paramount to making sure that they're equipped with the information they need to not default on the loans. So
Sure, of course. And I guess that would also be the biggest concern, right? Maybe do you ever find that investors could maybe be in a bit over their head and they're thinking, oh man, I got to get this extension now, and that
oh
could
yeah, it
affect, yeah.
happens. Yeah, it happens. I mean, especially first timers that don't properly budget the amount of time and doing things the right way. So we had one into last year. I think he sold October, November, and he got the wrong realtor in the first place. He didn't have the right team. You know, any business will fail if you don't have the right people, because that's all. It's all just getting the right people in the right seats. And so he hired the wrong realtor. Sat there for months after he completed the renovation. He did a lot of work himself. He fell out of the attic, busted his knee in the garage. Like he like split open. He called me like not long after and told me that happened. And anyways, then he was marketing it and it got broken into and they stole the appliances. Okay. And he didn't have the right insurance. He didn't use us for insurance. We gave him an offer of insurance, but he went with a goosehead agent who gave him American Modern policy that had no theft insurance or vandalism. Didn't have the right policy. Okay, so he learned an expensive lesson, had to buy new appliances in the kitchen. And it was a pro job. Maybe the people who put him in too, who knows?
Mm.
Like he had some, you know, his own cameras in there, like I don't know what it was, Ring doorbell or what. He told me he had a camera on it.
Yeah.
He watched him do it, and they were out in minutes.
Mm.
They broke a sliding glass door, so that was a little more money for him too.
Uh,
And so, anyways, he had to fix that up. You know, it took him a little longer than he expected, and I think he sold it right around when the extension was. But yeah, it's stressful for you, you know, to realize, hey, I'm gonna have to pay 1% and the rate may be a little higher to extend this on that.
yeah.
And so he learned some valuable lessons. He ended up winning in the end and got out, you know, and sold the place. But yeah, he may have learned a little bit of a valuable lesson on there. Um,
Yeah.
it's just one of those things you sometimes win, sometimes you learn. And if you make a little money when you're learning, that's okay, you know. So
Mhm. Yeah, I can see how that's a little frustrating when things don't go according to plan. But you brought up something interesting about insurance, right? So if I'm going in, I'm doing a flip, obviously I'm taking the risk myself, putting my money into the deal, but also, there's also the risk that the lender has as well. Could you also speak on what sort of insurance I would need as an investor to flip a house?
great question. So there's really two insurances you would pick, one or two. So if it's not an extensive renovation, it's just a dwelling fire policy. You just need to have the right endorsements like vandalism, malicious mischief. Those are important things to have. Okay. And then I always encourage people to have water coverage. They don't think of that, but that's the second most common loss in Texas. I know you're in Houston, so that's why I say Texas. I'm sure it's similar in many other states. I'm not licensed in those states, so I don't speak to them. I'm not an expert there. But it's important to have those coverages besides your normal wind and hail, which is the most common loss, and then your standard fire insurance. Then if it's an extensive renovation, you may be required to get builder's risk insurance. Okay. Or if you're building ground up, you will be required to get builder's risk insurance. And so just making sure you have a good agent that cares about helping you and goes through the policy and actually talks to you about what's covered and what isn't up front is imperative versus, hey, I got your quote. It's $500 or it's $1,000 or $3,000. Is that good? Okay, thanks, bye. Because that's what a lot of them will do nowadays.
Yeah, completely,
You
completely.
need to take the time, especially if you're new, to make sure you know understand your policy, what's covered, what isn't, and know that the agent is trying to make sure they're asking the right questions in order to cover you the way you'd like to be covered in that property.
Sure, of course. I think, and you get little weird scenarios. Even someone wanting to flip a house, and they'll tell you something like, "Hey, there's a lot of brush, behind, and some guys will burn trash. I'm concerned that something could spill over, and my house could catch on fire."
Yeah, look at California, man.
Yeah,
I mean,
yeah,
when it picks up, it blows the wrong way. It's a little drier, you know, the grass is a little drier this time of year. You know, if it
yeah.
hasn't been raining or snowing or whatever, you get a pretty ugly situation pretty quick on there for somebody who's not being very thoughtful.
Absolutely. So yeah, making sure you're covered there. And I'm assuming with a builder's risk policy is more of if you're taking out a wall or doing something really heavy.
Yeah, it's gonna be more than that, probably. Like one, if it's not a load bearing wall, we're not gonna care, you know, if it's just really cosmetic stuff. But yeah, if it's low, if you're taking pretty significant renovations, like maybe over 30-40% of the value of the home, that's when they're gonna say, okay, this is significant. What are we doing here? Are we adding square footage? Are we knocking down walls and making an open floor plan in some older house that wasn't? What are you doing? And so, it's going to be more significant,
Mm.
30-40% of the project. they're going to say, okay, yeah, you got to have builder's risk on this. It's not a standard dwelling fire. There's a lot more happening here. We need to be covered in case something happens when they're doing construction. We don't want to
Sure.
be liable for that.
Yeah, yeah, that makes sense. And you also mentioned something interesting about that investor. Obviously, it's hard hearing that it sounds like he hurt his knee, but
Yeah, he's
in
fine.
the
He's
yeah
fine. He called me about doing another
yeah
deal after he sold it. Um,
okay, glad
yeah,
he's
he's like he works at GM in Arlington,
okay.
and so he's a tough guy. He's a
Yeah.
pretty tough guy. I know he does like off-roading trucks and stuff like that.
Oh, okay, he's all
Yeah,
right. Yeah.
he hurt himself for a while, but he
Yeah.
recovered and he's doing okay now. I know from talking to him. I asked him like I'm like, how's your knee, dude? I'm
Yeah.
like, you
Oh
don't jump into
man.
the ceilings, are you?
Ouch. Ouch. Well, that's
Yeah.
good to hear. I'm glad he's all right. But I guess,
Yeah, he's fine.
speaking of an injury, for example, if I'm putting money into this deal, I'm the investor, and one of my guys happens to get injured, could they, how is this covered? Or how do I make
Great
sure I'm
question. Yeah,
covered?
great question. So your insurance is going to pay some amount out for medical, and it's not really as much as people think. It's probably like $1,000 to $5,000 most of the time. That's what even like a normal homeowner's policy has. But then they provide you personal liability coverage. So if you get sued, then they're paying out 100, 300,000 to defend you. And the average lawsuit, by the way, on insurance is $220,000 in 2023. When I looked last, I haven't seen numbers for 24 yet. But so I think it's imperative to keep at least the 300,000 for personal liability. And when you have the 5,000 in medical payments to others, a lot of times if they have health insurance, God willing, or the damage is under 5,000, that's going to take care of it for most things. So I broke my arm a couple of years ago. It was about $6,000 to get surgery because I had to have the radius and ulna both were broken and my arm was hanging there. And anyways, I got plates, 14 centimeters worth of plates put in and a bunch of titanium screws, and it was about $6,000. Even though I had insurance, that was about the deductible. They seem to know the numbers, anyways.
Oh,
Yeah,
oh my goodness. Sorry to
insurance, it's the
hear.
biggest scam ever, Aaron.
Ah, ouch. Yeah, trying to mitigate any sort of risk there,
Yeah, you
Uh,
do your best to, but you're trying to balance the premiums with the coverages, and so, anyways, having medical payments to others, I think of about 5,000 or so on the policy is important, and then making sure you have that personal liability in place, because then the insurance has got to pay to cover you if they do sue you. It's
hmm.
insurance's responsibility to pay out up to that 300,000 to cover you. So
Absolutely. And I guess speaking of paying out and just other potential issues, I know we spoke, I live here in Houston. A lot
yeah,
of Houstonian investors are concerned about you mentioned water damage, flooding. We
right.
know that Hurricane Harvey rolled through, a number of years ago, but people still actively think about it when they're
Oh,
investing.
barrel is good for some places. It got a number of our insureds. Like I had a guy today who was asking me about getting his recoverable depreciation check from a carrier, and so he got a new roof and fence from it.
Oh
And
wow.
so it's always a concern. Any coastal area, whether it's Houston, Florida, Louisiana, whatever, you really have got to make sure you have those proper wind coverages. And in certain areas there in Houston, specifically, if you're east of 45, they won't cover wind. Like the carriers are going to exclude it, and so we have to get a separate TWIA policy in those instances from the Texas Wind Insurance Association. So yeah, you got to have an agent that knows your area and how to structure the policies properly, and make sure they're giving you the right blend of policies there to cover the right risk for that area. So great question.
Absolutely. Could you maybe to go back a bit, could you talk about that depreciation check and exactly what he was
Yeah.
asking you for?
Okay, so if you actually replace your roof and the adjuster puts on there like, okay, this roof was depreciated on there by $3,000, let's say, okay, because it's 7 years old or whatever it is. And so if you actually replace the roof, then you tell the insurance company, hey, I replaced the roof. Here's the proof. Here's where I paid the contractor more than what you gave me, paid my deductible. And then in your adjuster's worksheet, it says right here, there's a couple depreciation that I'm owed if I do the roof. So you just get that other $3,000 in that instance because you actually replace the roof. Because some people take the money and don't fix it. Like I had a call with a lady today who I've financed at least 8 houses for. Okay, in 2017, when I met her, she had a primary residence and a mobile home as a rental. She has 8 houses. She's building 5 more on 6 acres. that she'll sell each one of those for about 300 in profit. She's selling for over $1 million each in Rockwall. And she bought a house from somebody in 2019 where they got a check on the roof before they closed, and they never fixed the roof. And so Safeco denied her roof claim here this last year in March
Oh,
with
wow.
a hailstorm. Yep.
Oh my goodness.
Yep.
Huh. Yeah, I guess in North Texas you do see a lot of, hail damage and wind issues too.
Law. Yeah, that's the main loss here.
Wow. Oh my goodness.
Yeah.
Yeah, I'm always curious because even other investors have also asked, if I do have a potential deal here and oh, this roof is kind of old, it hasn't been replaced in 20 years. There's really no issue. Should I replace it? Should I not? How do I get covered? Is it worth even doing this deal?
Yeah, those are all individual questions you kind of ask yourself and decide your level of risk. The only thing I would say on the piece about can you get coverage? Yes, but they're going to do an actual cash value policy. Most of the time, if you're over 10 or 15 years old on a roof, they're going to say, we're not giving you replacement cost coverage. So we're not going to pay the amount it costs to replace the roof less your deductible. We're only going to pay what the depreciate value of the roof is. And then you replace it, you'll get some recoverable depreciation
Hmm.
on there. So yeah, with older roofs, the insurance carriers are skirting responsibility, in my opinion, by putting those on there to reduce their risk. So
Sure.
it is something you have to decide. And if you're an investor and you're selling it quickly, it may be a non-issue. If the end buyer doesn't care, if it hampers your being able to sell the property and it sits there for months because of it, it may cost you more than just asking the seller to replace it before you go in. If there is damage there, get a roof inspection and say, hey, look, I mean, if it's a wholesale deal or something, you're probably not going to get anything. But if you're dealing with an individual, say, look, I want a new roof on this. What if I bump the price by your deductible? Negotiate, think it through, use your ideas. You
Yeah.
know,
Oh, that's a good idea. That makes a lot of
yeah,
sense.
yeah.
Very nice, Brad. Well, I know we covered a lot of ground here talking about loans, the lending side of the business, also mixed in with the insurance. Is there anything you haven't said you'd really just like to hit home for us?
I think it's something that everybody should have a side hustle in real estate. I really think so. It's one of the only ways you're going to get out of the rat race, unless you have a large stock portfolio. Maybe the only way you retire. Okay, if you don't have a 401k or some sort of retirement account, real estate is your best bet to be able to actually retire. You build residual income streams by getting rental properties, having experts help you until you are the expert yourself and know how to manage that. I've had people that like literally made real estate empires from snow cone stands.
Hmm.
I'm not kidding you. And Sherman, this guy, he was an engineer, smart guy, but he had 24 real estate properties by the time he retired, and he bought a lot of them cash until it got more expensive. He had to finance, but he was making about 60, 70 grand a year net on snow cone stands, and he was buying houses cash, and he replaced a six-figure income in retirement with those. So building those residual income streams and having the appreciation from them, where you can sell the assets eventually and cash out if you don't want to manage them anymore, or if you get over a certain number. If you have 10, you probably should be having a management company take care of them. Which, ask Aaron or myself if you need help with that. We'll refer you someone. But you really need to be in real estate. I think it's the best decision of my life I've ever made. And I think it would be for a lot of people out there too that don't have a lot of hope.
Absolutely, Brad. Well, thank you so much. We'll make sure to put your information in the show notes, right? So if someone wants to connect with you about lending and insurance, I love that bit about real estate, right? We're all in the real estate business because we all need somewhere to live, and you may as well do the best you can.
Yeah, you got to sleep somewhere. You might as well own it, And so I appreciate you having me on, Aaron. It's a pleasure to meet you here recently and be on your show. And I hope we had some good words for your people out there that gives them hope and helps lead them to prosperity.
Sounds great, Brad. Again, guys, we'll have Brad's information in the show notes. This is Aaron from Houston signing off, and we will talk to y'all next time.
See you, Aaron, man.